A very good evening to all of you students. My name is CA Divis Gupta, and today we will be discussing on the topic of working capital. So let us start, students. Working capital is a very important topic and it's really practical in terms of its approach. So let us start with some of the basic things. Then we will also follow it with some of the questions that have appeared in some of the past examinations as well as in RTP, as we did in dividend decisions. So students, just to start with, first of all, working capital is actually a difference between current assets and current liabilities. Now, if you see any company, it needs two forms of capital. One is the long-term investments, sort of investments into, let's say, the fixed assets, the assets which help company to, let's say, make inventories, right? Which are in the form of property, plant, and equipments. And the second type of investment is generally for the day-to-day requirement, which is termed as the working capital, right? Because it will be used for in the form of inventory. When you sell the goods to a debtor, in the form of a debtor. When we purchase, it will be in the form of a payables, right? So broadly, we can say that the funds requirement for the company are of two types. One is from a long-term perspective, which is the long-term investment purposes, and second one is the working capital. The long term one is the capital expenditure that we say. Shruti, good evening. Kiran, good evening. Sweetie Kumari, good evening. Sushil, good evening. So, okay, Kiran has a question. What is overcapitalization? I will take it. Okay, I will take it. Once we start with the basic things and come into the flow, I will definitely tell what is overcapitalization. So yes, now coming to working capital, right? Because in your previous sessions, you would have already studied about the capital expenditure, right? In capital budgeting, you decide whether to invest into that project or not, right? That is from the perspective of long-term investments. Now coming to working capital, students, we know that is actually current assets minus current liabilities. Okay. Simple. So working capital is equal to current assets minus current liability. Now the term to be noted here is that we always take current and current, right? So we need to understand first, what do we mean by current, right? Is there some guidance on the current? Definitely yes. So current is something. So in the asset parlance, current is something which is expected to be realized within the normal operating cycle of the company or within 12 months. Okay. So it says that, let's say you have a debtor, right? From whom you have sold the goods and there is a receivable. From that debtor, you have to receive the amounts within 12 months or within the normal operating cycle, then it is current for you. But you have said that, okay, I've given the amount to debtor, perpetually, whenever he or she wants to pay, he can pay, and there is no right. I mean, they are outstanding for more than 3 years, and in future also it is more than 3 years. My normal operating cycle is, let's say, 6 months. So I will not say that it is a current debtor. Okay. So one is that it should be, I'm putting down here for current assets. I'm just putting the broad things, right? So for current assets, it should be expected to be realized or settled within normal operating cycle or 12 months from reporting date. Okay, so this is the first criteria. If this gets satisfied, then it is a current asset. Now, students, you would have noticed for some companies, the normal operating cycle itself is more than 12 months, where the process of production of an inventory is more than 12 months, right? Still, if it is within the normal operating cycle, it will be classified as current. Okay. And second one is the asset is held primarily for the purpose of trading. So, which is in a way we call it as inventory, right? Purpose of trading. And nowadays, students, I can tell you, if you go through any financial statement of any company, it is very easy for you to look at the current and non-current bifurcation, because all the companies have to mandatorily report current and non-current classification of all the assets and all the liabilities, right? So from there, as a user of financial statement, we can pick that data of current, okay? And the definition is very similar. What we are studying, there also they follow the same definition, right? Now, just to give an example, so inventory, the purpose is trading, right? So inventory is there. Then in inventory, we all know raw material is separately there. WIP, working progress is there. Then is inventory. Now, similarly, there are receivables, right? Receivables on account of the goods sold. Even we call it as, let's say, debtors, and it can be bills receivable also. If let's say we have done discounting, or let's say we have sold these debtors, we will discuss that in detail, right? So in the form of bill receivable, it will also come. Then cash and cash equivalents. Whatever cash you are holding, whatever amounts in the bank account you are holding, whatever short-term fixed deposits you have taken, whatever liquid investments you have done, these are all cash or cash equivalents. Then prepaid expenses are also part and parcel of the current asset, students, right? And it can include other advances, other things as well, as long as they meet this definition of the current advances. Okay, let me just see if there are any queries. Just a second. Perfect. Oh, yeah. So these are the broad definitions of current assets. Now let's come to current liabilities. So students, current liabilities is something which is expected again to be settled in the normal operating cycle or within 12 months of the reporting period, right? And it is settled either by current assets or by creation of new liability, right? So these are the two conditions. So one is expected to be settled within normal operating cycle or 12 months, whichever is longer, right? And settled through current assets or new liability. So let's say that liability will be settled from by using the cash and cash equivalents, right? So hence it is settled through current asset. Okay. So I hope the basic part of working capital, let's say what is working capital? Working capital is current assets minus current liabilities. Now what is current asset? What is current liability is clear. I've just mentioned some of the examples for current liabilities. One is, let's say the biggest one is the trade payables, and the second one is the outstanding payments, or let's say any sort of provisions for the revenue for the regular expenses. Those will also be part of this. Now, our topic is management of working capital, right? Now, in that working capital, we have understood. Now, the management of working capital is actually a process in which we make sure that the organization is able to operate efficiently by monitoring and even utilizing the current assets and current liabilities in a better manner. So students, what happens? Let's say current liabilities has to be paid and current assets has to be realized. So the way it has to be paid and realized, it should be in a manner such that the day-to-day working is not distorted. Okay. Now let me give you an example. Let's say I have a trade payable. I have a vendor with whom I have agreed for a payment days of 30 days. Okay. On the other hand, I have sold the goods to a debtor and he is agreeing for paying to me on 60 days. So what I'm doing on 30th day, I'm paying to the vendor and on 60th day, I'm receiving my collections. Do you think, is it a efficient way of managing my working capital? I'm just asking practically. Do you really think it's a efficient way of managing the working capital? Come on, students. Shruti has replied no. Definitely no, right? Why? Because I am not having I am having a mismatch between the realization and the payment. So either I should ask my debtor to pay me on 30th day, or I should ask my vendor to increase my credit terms to 60 days, or I should make some other arrangement for the balance 30 days, provided I don't incur extra cost, right? So I think Sushil is asking to read the. Okay, Ruhani Jain is saying not efficient. Sriti Kumari is saying no. Perfect. So Sushil is asking, please read the definition of current assets. Okay. So the definition of current assets, I will read it. So it says that it is expected to be realized or intends to be sold or consumed in the normal operating cycle of the entity or within 12 months after the reporting period, whichever is longer. And the asset is held primarily for the purpose of trading in the ordinary course of the business, right? That is what I've just put it in a very, the lame language, but the exact language is written there. Okay, perfect. So, so the management of working capital is all about this, right? Wherein you try to make sure that your current assets and your current liabilities you are utilizing them in a proper manner so that the organization's working is not getting affected or impacted, right? Now, if we see the working capital can be let's say presented in two different forms, right? First of all, on the basis of value, which is gross and net. And second is on the basis of time, which is permanent and fluctuating. So the gross and net, student. Now, gross is actually the investments in the current assets. And net is actually current assets minus current liabilities. Okay. So any which ways for us, what matters is the net working capital, but still sometimes the question mentions gross working capital. So please understand it is talking about only the current assets. Now from time perspective, there is some permanent and fluctuating working capital. Now imagine a company like Coca-Cola, students. Coca-Cola will have a seasonality to its business, right? When it is summer, the consumption will be very high. Hence the requirement of production will be very high. The inventory will be very high. The sales debtors will be very high. The payables will be high. So you will see that, that's a very temporary phenomena for 6 months. And permanent will be, let's say they are having their own business on a permanently basis, which is, let's say, 1,000 crore, and on a fluctuating basis the business reaches to 1,500 crore. So the extra 500 crore is the fluctuating one, is a fluctuating business related performance, and the permanent one is the regular stable business. So the working capital required to carry out your permanent operations is the permanent working capital, and fluctuating working capital or temporary working capital depends on the business cycle. The moment business cycle increases, their sales volume increases or decreases, it has to be going in that tandem. Okay, clear, students? Perfect. Now, then, so this is just a classification of gross and net, permanent and fluctuating. Okay, students. Now let me ask you a very good question. Is what is okay? What is the adequate working capital according to you? Or what are your thoughts? What is the right working capital according to all of you? If I have to, you know, quantify it, since we know that current assets divided by current liabilities, right? I'm just putting a divided by here just to find out the ratio, right? Which is the current ratio. So I would say that if current ratio is 3, 2, and 0.5, I have given you three options: 3, 2, and 0.5. What do you think? A, B, or C? Which one is the optimum? Which one is the optimum or adequate working capital, students? Come on. You can mention A, B, or C while you're answering. Is 3 a good working capital because you have very high current assets? You have almost 3 times the current assets what you are having a 1 time of current liability. Or B is the optimum, C is the optimum because C, you have very low current assets compared to the current liabilities. So Shruti and Ruhani have answered. Okay, Sushil has also answered. Sweeti Kumari has also answered. Devesh has also answered. Very good. I think all of you are on the same page. Very nice. So as all of you have mentioned, 2 is the right answer. 2 is the right answer. Why? Because higher working capital, or let's say higher current ratio, will mean that we have over invested in the assets. Somewhere we have to bring down our assets in the current assets. And lower working capital or lower current ratio means that we have a risk of insolvency. We might get into the risk of insolvency because tomorrow, let's say the payables comes to me and ask for the payment, I might not have sufficient liquidity to pay them, right? Because it is 0.5. And hence, the optimum working capital is the current ratio at 2, students, which all of you are aware of, right? So yes, Sumit, you are also correct. So the point what I'm trying to make here is higher is also not good, lower is also not good. The optimum working capital is 2, students, right? Then let's come to the concept of overcapitalization. I think there was one question asked, one of the query that has come from Kiran Shukla, right? What is the meaning of overcapitalization? This is overcapitalization, Kiran. If you see, let's say I'm maintaining very high investments in my capital. My current assets are very high. Without any objective, I am carrying very high investments, which are leading to the inefficient operations of the company, right? The return on investments is coming out to be very low. Mostly, in previously, I would say some years back, the PSUs had very heavy balance sheet in which the investments used to be very heavy, right? So that is where we call it as overcapitalization. That means we have to bring down the amount invested as capital. Okay, students. Now optimum working capital is done. Okay, now if you see, there is another term called quick ratio or asset test ratio. Okay, now what is this asset test ratio or quick ratio? In this, what we do, we just take the quick assets divided by quick liability, current liabilities. Now, what do we mean by quick assets? At least current liabilities and current assets, we are clear. Now, quick assets is actually the difference between the now quick assets is the current assets less. Just a second, there is one query. Sorry, is OWC always 2? Kiran is asking. Yeah, yeah, optimum working capital always is meant to be 2. It is better if it is 2. Okay, so this is always, I mean, optimum working capital is always 2. Okay, now we were on to the quick assets, right? So quick assets is actually all the current assets. From that, we reduce the inventory and prepaid expenses. Reason being, inventory and prepaid expenses cannot be realized immediately. So that is where we have current assets, less prepaid inventory, less inventory. Yes, Kushi, very good. Kushi has mentioned this. So this is really available, that can be turned around into cash. So the optimum quick asset ratio is always 1, right? So we say that it should always be 1. So these are some of the building blocks of what we understand from the working capital, how it should look like, how we can manage it, right? What are the background for managing it? Now let's come to the determinants of working capital, students. See, as a finance professional, we have to first of all understand that what are the working capital requirements of a company. We have to plan for it. We have to make sure that what is the right educate level for the working capital. And then we have to make sure that the working capital is within the same range, right? So hence, in determinants of working capital, also the first step is to maintain adequate working capital. In this, we make sure the individual level of the current assets and current liabilities are what we have to measure that, right? And the second part is how I am going to finance that working capital. So first is to maintain the individual level of current assets and current liabilities. And then second is the financing part of the working capital, right? So, as finance manager, I also need to make sure that how I'm financing the working capital. It has to be financed in the right manner. It cannot happen that I am financing it from the long-term sources and putting it up for the current assets. If you do that, then what will happen? You will not be able to repay back your long-term finance related issues, right? And even you cannot borrow on short-term basis and invest in the long-term purposes. Even opposite will lead to less liquidity, right? So it has to come through a proper finance, right? We will discuss the modes of financing also. Financing the WC needs, right? So these are the two basic things that we have to answer. Now, mm, while maintaining, or let's say measuring the individual level of current assets and current liabilities, we have to keep certain things in mind, right? There are certain factors that drive that discussion or decision. Okay. Now, what are they? These are again mentioned in your study material. I'm just picking up from them from there. See, first of all, students, it is need for cash. So every business has some aspiration that, okay, this much cash balance I will have to keep for maintaining my day-to-day expenses, right? At the same time, I have to keep in mind my cost, cash holding cost, right? Because I will be losing the interest on such amounts. Then second is I have to also make sure that what is my desired inventory level, right? If my desired inventory level is lower, because I am running a very efficient production line, I'm doing just in time, right? So in that case, my desired inventory level should be lower. However, if my production process is such that I have to keep inventory levels at a higher amount, or my business nature is such that my inventory level has to be high, then in that case, I have to plan for higher working capital. So students, if you see, we are still in the planning stage. As I'm telling you that we have to determine the working capital, right? We have to determine the individual level of working capital. This is a planning stage, right? So in planning, what all things will be useful to you? One is need for cash, second is desired inventory level, then third is receivables. So in receivables, what policy you want to drive? Whether you want to keep 30 days, 40 days, 60 days, or how much you want to give the credit. One thing, students, if you give higher credit, there are chances of higher sales. If you give lower credit, the chances of sales being lower is higher. Second thing, the probability of default also needs to be taken care of, because if you give the credit to those parties which are defaulters, then in that case, the cost of doing the business will be higher. So on receivables, these things have to be kept in mind. Then the next one is short-term financing options. So these short-term financing options are available in the form of cash credits, in the form of overdrafts, in the form of short-term loans, right? So as a risk-taking capability, whether you really want to make use of such facilities, right, is another question that has to be asked. Then obviously nature of business, students, right? Now, if I take an example of a restaurant, in restaurant, almost all the sales happens in cash basis, right? Almost the payment comes in the same day or the very next, right? So in that case, the working capital requirement will be minimal because there are no debtors, right? On the other hand, if you imagine for any other company like FMCG, which is selling it to a retailer and then retailer is selling it to us. So generally retailer will ask for 15 to 20 days of credit, right? So nature of business really impacts your adequate levels for working capital, right? Then market and demand conditions. So students, you would have always noticed that if a product has a high demand in the market, right? So there you need not have a very high working capital because consumer will go and ask for that product, right? It has a very high demand. But on the other hand, if some product is not in demand at all, I have to maintain for higher working capital for that product. Correct. So in a way, the demand to some extent drives your working capital levels. Correct. Then next one is technological and manufacturing policies. As we said, as we discussed, that if you are following a just-in-time, manufacturing process, if you're following a very efficient manufacturing process, wherein the raw material is coming from one end and it is FG is going to the other end, so that means you barely have to maintain any inventory in the form of WIP, inventory in the form of big amount of raw materials, right? So this we are talking about technology and manufacturing policies. Right, then the next one is operating efficiency. This is again related. This is again related, students, right? It has to be done in it has to be operated in an efficient manner. And lastly, price changes, price level changes, and forex fluctuations, foreign exchange fluctuations. Now imagine some of your debtors are outside India, or some of your creditors are outside India. Now you are purchasing or selling it to them. You are exposed to foreign exchange fluctuations, right? If the prices of dollar the prices of dollar compared to Indian rupees, it increases or decreases, it will impact, right? Similarly, price level changes. If the vendor increases the input prices, it will also impact your working capital, right? So you have to carefully, mm, get to the levels of the working capital. So students, if you see practically, right, what happens is all the companies prepare their cash flow or working capital related forecasts in which they try to plan for what are the right levels of working capital. right? And while doing that, they will keep into mind all these things, right? So in a way, for us as a finance manager, also as a finance professional as well, we need to make sure that the planning is correct. If your planning is correct, then let's say once you have planned, you'll come to know that for the next year, the current ratio basis this working or basis this planning is coming out to be, let's say, 3. Now, what you will do, now you know that either you can increase your current liabilities or you have to reduce down your current assets. So that means you will have to restructure some of the things. You will have to think it that should I reduce my cash balance? Should I invest it in a long-term asset rather than keeping in the current assets, right? So all these leverages you will do, and that is why it is called as the entire management of working capital. Okay. So any questions till now, students? Till here, any things? Perfect. So let's move ahead. Now, if you see, there are, I mean, a lot of times the question or somewhere we have mentioned the terminology of working capital cycle, right? Now, what do we mean by working capital cycle? The working capital cycle means the moment you pay to a vendor and the moment you receive from a debtor. So the entire cycle will be covered as the working capital cycle, which includes your inventory holding, which includes your debtors holding, which includes your payables holding. So what I can say is, see, I'm just telling you that let's start from, let's say, debtors, inventory, and payables. This is getting reduced, right? So this generally we call it as core working capital, right? And then in this we add other current assets, let's say any loans and advances, short-term prepaid expenses, right? All those things get added, and we reduce other current liabilities. For example, any other provisions that we are carrying on a short-term basis, right? So, so these this is how the amount is calculated now in the form of a cycle. First of all, using cash, you will purchase your raw materials. You will also pay it for labors. You will also pay it for overheads, right? Then you will come at work in progress. Then you will come at stock. You will be able to produce the stock. Then you will come to receivables. And then finally you will realize cash. So again, you will put the cash into the vendors, into the vendors bucket. Vendor will give you raw material, labor overhead. You will do WIP, and hence it will carry on. Okay. Nice. So this is what the working capital cycle is, students, right? Now, in terms of the number of days, I will just put it. Let's say debtors are generally 30 days. Inventory are, let's say, 10 days. Payables are, let's say, 15 days. Other current assets takes another 20 days, and other current liabilities will take 5 days. Can anyone tell me what is the working capital days? Come on. I'm also doing the calculation. So basis these numbers that I've plotted on the screen, just tell me what is the working capital cycle or working capital number of days. Very good, Sumit. Kiran, very good. Ruhani, very good. So it is 40 students. Very good. So in a way, 40 is the working capital days that we are targeting upon. And I'm telling you, it's a very good interview question, because a lot of people ask in interview whether negative working capital is good or bad. Come on, tell me your thoughts, students. Is negative working capital good or bad? No, Devesh, it's not 80 days because payable and other current liabilities, you will reduce it, Devesh Patkar. Okay? Khushi, you are right. Sweetie, you are right. Perfect. Thanks everyone for answering. Okay, Kiran and Ruhani are saying bad. Bhumika has also replied. Very good, Bhumika. So, my question to all of you is now understand, because it's a very tricky interview question that comes once all of you will qualify CA. That is, working capital, is negative working capital good or bad? Now, all of you are saying bad. Sushil, Sweetie, both of you are saying bad. Ruhani, Kiran, both of you are saying as bad. But why bad or why good? Is it that straight away answer? I mean, is it that clear that it is good or bad? I can't still say it's good or bad. I will still have arguments in the favor of good. I will still have arguments in the favor of bad. I can tell you how. See, one argument in the favor of bad is the moment you say that you have negative working capital, right? Let's try to decipher it. The moment you say it's a negative working capital, that means your current assets are less than current liabilities. Okay. That means you are using short term sources of finance to invest into long term assets. I hope you are getting my point. The moment your current liabilities are more, let's say current liabilities are 1 lakh, current assets are 50,000. So balance 50,000 of the current liabilities through which current assets are not there. That means it has been invested into the balance sheet, into the long-term assets, correct? Because that is the only place left. Now, the moment you say that, it's a very risky situation, because the moment it gets invested into the long-term assets, tomorrow if the current liabilities payments comes up, I cannot liquidate my long-term asset to pay that current liability, because long-term assets will get liquidated after 5 to 10 years. Current liability will be due in another time, right? So Kushi is also saying bad. So this is one of the argument in bad. Now let us think about what are things. And the moment you say that your current assets is less than your current liabilities, then what you have done is you have over optimized your working capital. It's very much optimized. That means your business is such that your vendors are willing to give you a interest free credit. So your cost of credit, so this is something bad, this is for something good. So your cost of credit is negligible. You are able to enjoy this extra 50,000 at zero cost. So don't you think commercially it is good, right? Because today what companies would want themselves to be in a situation where they end up spending lower finance costs, right? Lower interest cost. So Sushil Kumar Barik is saying negative working capital means current liabilities more than current assets. That means company not in favorable position to pay the liabilities. Yes, Sushil, that's what we discussed here. Correct. That is bad. But good part is that okay, I can do one thing. If let's say I cannot liquidate my long-term assets, I can take another short-term borrowing to repay my original borrowing, right? I can do that, so I can manage the liquidity position in case I don't even have the current assets to pay. Okay, that is manageable at one point. But the good part is that I am getting a interest-free credit, which the banks would have charged me hefty interests. Correct? No, Kiran. Kiran is saying, what if invested in long-term assets? It has to be, right? I mean, if you see the balance sheet, only two things are there. Either long-term assets, which are, let's say, your property, plant and equipments, fixed assets that we say, right? Or second is your short-term assets. Short-term assets are current assets. So it has to be invested in either two. Okay, perfect. So let's go ahead, students. Okay, so So operating cycle is clear. Perfect. Now there are some formulas that we need to understand. I think most of you would know this. For example, we have to calculate the raw material storage period. Okay, this will be average stock of raw material divided by average cost of raw material consumption per day. So this will tell you that on an average, for how many period we keep the raw material stocks with us before it gets into WIP. See, the process is clear, right? For any manufacturing company, first you purchase the raw material, then you go for the work in progress, then finished goods, then you sell that stock. So we have taken here average stock of raw material, students, because this is really the average that we're talking about, which is opening and closing divided by 2. Simple. Okay. Then work in progress inventory holding period. Okay. Below we have taken average cost of RM consumption per day. Okay. So that will give us for 1 day, what is the consumption? Total stock we have this much. So if we divide that, we will be getting that for how many days we have the sufficient cover, or what is the storage period. Then second is WIP, inventory holding period, is equal to average WIP inventory divided by average cost of production per day. Clear? So this will give us how many days we will keep WIP in the process. Third one is finished goods storage period, average FG inventory divided by average cost of goods sold per day. Okay. Perfect. Then receivables collection period, students. So in how many days we are on an average able to collect our receivables. So this will become average receivables divided by average credit sales per day. Sorry. Then lastly, we have payables credit period allowed by suppliers, or I can say payables period in average payable. These are self-explanatory, right? These formulas are self-explanatory. Average credit purchases per day. Okay, students. Okay. Now let us go to one of the questions, question number 1D. So what I'll be doing is, let's do the question that has appeared in November 2023. Okay. Question number 1D. I hope my screen is visible with question number 1D. Okay. This is a very good question. We thought of discussing it in the class. So X Limited has furnished following cost sheet of per unit cost. Raw material cost 150, direct labor cost 40, overhead cost 60, and hence total cost is 250. Okay. The profit is 50 and hence the selling price is 300. So 250 is the cost and selling price is 300. Okay. So students, one more thing I have to tell you before this, which will be useful while solving this question. See, what happens, our raw material is at cost, WIP is again at cost, inventory for FG should also be at cost, okay, while you are doing your working capital. But debtors is actually at revenue, right? Because debtors is recorded at the gross amount receivable, right? So hence it is recorded at a overall revenue basis. So there are two ways to include debtors into the working capital scenario. One, we take it at revenue, let's say at sale price itself. And second, we take it at cost. Okay. By cost, we mean whatever is the cost of that good sold, right? That we will take as, because your real investment in the working capital is equivalent to the cost, not the profit, right? Because if you see, revenue minus cost will become your profit. So what you are doing in the first option? In the first option, you are inflating your debtors in a way for the amount of profit which is not even your cost, and that amount is not stuck in your working capital. But the second school of thought says that yes, since we have sold at revenue level, so the recording in the working capital should also happen at the revenue level. Hence, I'm saying that we have to be really careful and see what the question asks us to do, right? Whether they ask us to do the debtors evaluation at cost or debtors evaluation at the revenue value. Okay. Now let us go back. The reason why it's struck to me, because it is mentioned here as profit as 50 and total cost as 250, right? Let us read further. The company keeps raw material in stock on an average for 2 months, work in progress on an average for 3 months, and finished goods in stock on an average for 1 month. So 2, 3, and 1. The credit allowed by suppliers is 1.5 months. So they allow us a credit of 1.5 months, and we allow 2 months credit to debtors. Okay. The lag in payment of wages is 1 month, and the lag in payment of overhead expenses is 1.5 months. Okay, this is also understood. The company sells 25% of the output against cash and maintain cash in hand at bank put together at 1,50,000. So they have given you additional piece of information where they are saying that not entire sales happens at credit. Only 25% sale happens at cash and 75% sales happens at credit. Why it is relevant for us? Because the amount that happens in credit will only be eligible for the working capital evaluation, right? Cash will not be taken into account for the working capital evaluation. Production is carried on evenly throughout the year. And wages and overheads are also similar. So they are saying there are no spikes in the seasoning. It is happening all across at the same level. Work in progress stock is 75% complete in all respects. Prepare statement showing estimate of working capital requirements to finance an activity level of 15,000 units of production. Okay. So they have given you that working capital is also at the rate of 75% students, right? So now they're saying prepare statement showing estimation of the working capital required to finance at an activity level of 15,000 units of production. Clear? So let's start, students. Let us first of all put down all the things that are given to us in the question. See, first of all, students, I can tell you that these questions are very logical in nature, right? There is no concept, there is no single formula that we can apply on this because these are very customized questions. So we have to go with the questions flow itself, right? So let us first try to put down all the information in one single manner. So raw material holding happens for 2 months. WIP happens for 3 months. FG happens for 1 month. Debtors are for 2 months. Creditors are for 1.5 months. Okay, then wage is 1 month outstanding and overheads is 1.5 month outstanding. Okay, so this is the entire holding period of the, or we can calculate the working capital cycle also, right? But it's not needed. Okay, so this is what the information is given to us. Meanwhile, I have to check in between for any queries also if they are perfect. So our fair solution starts from here. This is November 23, question number 1D. Okay, so statement showing estimation of working capital. Okay, so let's start with current assets. In that, we will go with inventories first. In that, let's start with the raw material. Okay, so students, if you see raw material, they have told us 15,000 units, right? For what is the rupee rate for raw material? 150, right? So 150, 40, 60. Let me mention that as well, so that we don't have to talk between the two. 150, 40. What was it? No, sorry, it's WIP. Wages was 40 and 60 is the overheads. Okay, so this will get multiplied with 150 divided by 12 months. into 2 months, right? So students, we are calculating the absolute amounts, right? Now, if the inventory holding period is for 2 months, so for 15,000 units, we will be holding it for 3,75,000 rupees. If we solve for this, right? Which is 15,000 into 150 for 2 months divided by 12. Then second part is WIP. Okay, now WIP is taken at 250, right? Because the cost of the goods sold is 250, but they are saying it is complete at 75%, right? So we will take 15,000 into 250 divided by 12 into 3 months, right? Into 0.75. That is where the 75% will rest. So it becomes 7,03,125. Then third is, no, wait, sorry, I think mentioned it. Second not, but it should be B, and then it should be C. Very good, Devesh. 375 was the right answer there. Now, the third one, which is FG, FG is for 1 month, right? So 15,000 into 250 divided by 12 into 1. 15,000 into 250 divided by 12 into 1, 3,12,500. Okay, so this comes our total inventory, 703,125 plus 375,000, around 13,90,625. Right, so inventories are clear. Now let's go to second one is debtors. Right, so debtors was for how much? 2 months. Perfect. So 2 months of debtors for 15,000 units being sold. Now here the question comes that whether we should take it at what level. So Devesh, your answers are perfectly right. Khushi, your answer is perfectly right. Very good. Thanks a lot, students, for answering. Bhumika, your answer is also correct. Now what I'm asking is, now we have to take a call that this debtors has to be at cost or it has to be at selling price. So we are taking it at cost because that is the preferred option, divided by 12 into 2 months, right? But is this correct, students? There is one thing that I have to adjust in this. Can anyone tell me? Is this correct, what I've mentioned for debtors, or I have to adjust for something? Meanwhile, I will calculate this. 250 into 2 divided by 12. Come on, students, tell me. You have to just simply read the question and answer the same. So my question to all of you is that if you read the question again and tell me whether debtors have taken at 15,000 units multiplied by 250 divided by 12 into 2. So is this the right thing that I have written, or there is something that I have to adjust it while we are talking about the working capital? Very good, Devesh. Very good, Sushil. You have rightly pointed out Kiran, yes, very good. I think all of you are right and up to the mark. 0.75. We have to adjust it for the creditors, right? 15,000 into 250 divided by 12 into 2 into 0.75 for the credit. So 468,750. Right? This becomes for the debtors, inventories and debtors. Clear? Yes, Kiran, your answer is correct. Then it was also mentioned about the cash and bank balance. That was straight away mentioned as 1,50,000. Right? So the total current assets will be 468,750 plus 1,50,000 plus 1390,625. 20,09,375. Clear? So let's say this is the amount that is payable. Sorry, receivable, I would say, in the form of a current asset. Very good, Bhumika. Your answer is correct. Devesh, your answer is 618,750. It should be okay. Plus 150, you have said. That is okay. 618 plus 750 plus 1390,625 is what we have to take. Now let us take it ahead, students. Now let's talk about the current liabilities. This was 1, 2, 3, then A, then now B. B is for B is for current liabilities, students. Now in current liabilities, we have three things. One is payables, outstanding wages, and outstanding overheads, right? These are also given. So payables. Now for payables, they have said to us what is the timeline, 1.5 month, right? So payables will be for what? Payables will be for the raw material, which is at 150, right? Because we will be for wages and for overheads, we are assuming separate amounts. Hence, for 150 itself, the payable becomes accordingly 15,000 units multiplied by 1.5 month multiplied by 150 divided by 12. Okay, 15,000 into 150 into 2.5 divided by 12. So 2,81,250. This is on account of payables. Yes, Devesh, your answer is correct. Sushil, the total is perfect. It's matching 20,09,375. Very good. Now, second one is outstanding wages. Now, if you see the outstanding wages is for 1 month, 15,000 units into 40 divided by 12 into 1. This comes as 50,000. outstanding overheads on 15,000 units. What is the per unit overhead rate? Per unit overhead rate is 60. And this will be for 1.5 months. One lakh 12,500. Four 750. Clear, students, till now? Yes, very good, Devesh. Your answers are correct. Liability is 443, 750, 1,12,500. Very good, Devesh. 60 is the overhead ratings. So, Kiran, I think you would have responded for the net working capital. Now, let me ask you, can you tell me what is gross working capital and what is net working capital? Although it is not asked in the question, I'm just trying to ask you because we have just now discussed, right? What do you mean by gross working capital here and what do you mean by net working capital here? Yes, Sushil, your answer is correct. Very good, Sushil. So this was a very easy question. It appeared in examination, but it's just simple calculation, right? Only one decision we had to make. And even if you would have solved the question using the sales value here for debtors, where it is here, instead of 250, had you have taken 300 also, that would have also been okay. This is also okay as an alternative solution, right? So both the ways it was okay because the question is silent. Net means less all expenses, Kiran is saying. All expenses or all liabilities, Kiran? Gross means working capital, net is current assets minus current liabilities. Devesh is saying, Sushil has mentioned gross is 20,09,375, working capital is 15,65,625. Very good. So gross is exactly this 20,09,375 and net is 20,09,375 minus 443,750, which is 15,65,625. So this is the answer that the question was asking. What is the? Yes, Khushi, very good. Your answer is also correct. Yes, Kiran, it means liabilities. Shambhavi has mentioned 1565, 625. Very good. Clear, I think. Very good. I think this question was, I mean, a basic question, but a lot of things would have got cleared right through this. Let me also now take you to just a second. So with this, now we know how to calculate the amounts, right? So now, students, if you see, there are two things, right? One is if we have been given amounts, can we calculate number of days? Yes. If we have given number of days, can we calculate amounts? Yes. Either ways, we can do the calculation, right? Now we know that what is the formula, and hence we can do that calculation, students. And second differentiating factor that is what we have discussed today is the cash cost, right? So in this that I told you, Where was it? For debtors? Yes, here. So in this also, if you see the cost, it also has two, three more components. Let's say raw material, labor, overheads. Now overheads also have two things. One is depreciation and second is other than depreciation. So this depreciation, students, is a non-cash item, right? Even though depreciation is included as a part of the overheads and hence as a part of the cost, but while calculating the current assets and current liabilities for debtors, right? For debtors, we will have to, I mean, debtors have to be included in current assets for working capital. For calculating debtors, we eliminate even profits and even depreciation as well, which is sitting as a part of the cost of goods sold. So this depreciation is sitting as part of COGS. So both these things are actually eliminated, right? While we talk about the cash cost of the inventory, cash cost of inventory and debtors both. So in debtors, profit plus depreciation will get eliminated. In inventory, only depreciation will get eliminated to arrive at the cash cost, students. I hope this is clear. We have to keep this in mind while we are solving for any question. Okay, so this was another discussion that I wanted to have. So cash cost of finished goods and sundry debtors. That is, in both these places, it matters, right? Now, there is a term called there is a term called treasury management, right? In this chapter itself, there is a term called treasury management. So first of all, students, if you see in any company, the main functions of the treasury department is to make sure the availability of funds, to make sure that the borrowing of the funds are happening at the lowest cost, to make sure any foreign exchange needs of the company are also taken into account, right? And at the lowest level, the foreign exchange is sourced, right? So it actually deals with the entire working capital management, right? The entire treasury function of any company deals with the working capital management. It also includes the forex and interest rate managements, right? By forex, I mean in case of foreign exchange is needed, so they will make sure that they are getting the forex at the very cheap rates, as well as for the interest rate management, right? Now the now the treasury management have certain key things. One is that they have to maximize the return on available cash, right? If the company is sitting on idle cash, so they will have to maximize the return. Similarly, if the company is having some sort of borrowings, right? Okay, wait. I think I will have to first take this query related to the previous part. So Devesh is asking how depreciation is calculated. So depreciation will be given in the question, because what happens while any value of COGS we talk about, cost of goods sold, right? So this includes overheads, and overhead includes depreciation. So let's say it'll tell you depreciation for the full year for plant and machinery is estimated to be 1 lakh. And let's say there are 20,000 units, right? So this 1 lakh divided by 20,000 units comes as 5 rupees per unit as depreciation amount, which will go and sit in the overhead and hence in COGS. You understood? Now, if let's say you produce more than 20,000 units or less than 20,000 units, so then that adjustment will happen later on at the year end. Okay. But are you clear from where we calculate the depreciation? Yes. 5 rupees will come as depreciation. So Kiran is saying, sir, did not get it. Kiran, what have you not get it? The treasury thing or what? I'm just explaining the treasury part. So what I'm saying is the treasury have certain objectives. The treasury function of a company have certain objectives. One, to maximize the return on available cash, right? So that means whatever investments they are doing on that, they have to earn highest. Then finance cost. Finance cost is basically the cost of borrowing, right? This has to be minimized. Then third objective is whatever, I mean, if you see there is a group and in that there are many subsidiaries, there are many companies. So how to move cash across all the subsidiaries or all across all the companies so that there is a tax efficiency, we don't lose tax, the dividend, everything is complied with, right? So mobilization of cash. And lastly, forex deals. Because what happens in forex, it's an open market, right? You might get a better deal depending on what you are purchasing, what is the demand of that. So they will have to keep on tab on what are the requirements of the foreign exchange when it is getting paid, and hence we have to take it in that manner. Okay, Kiran is saying available or idle cash. Perfect. So see what happens, Kiran. Let's say our business is such that every month it is earning a profit of 200 crore. So annual profit is how much? 2400 crore. Now let's say the business is not paying any dividend. So what will happen? In the balance sheet, 2400 crore reserves will go up. And similarly, to the equivalent amount, your cash flow will also go up, right? Now the amount will come and sit in your cash and cash equivalents, right? Because you have not paid any dividend. Whatever you have earned, you have realized, for example, and it is sitting in your cash and cash equivalents. So now that is called as an idle cash because you have accumulated that much amount in the cash and cash equivalent. Now what you have to do, you have to invest it, let's say in the risk free manner so that you are able to get the higher returns, right? So all that investment call is taken by the treasury team, and they have to take in such a manner so that the overall returns are higher. Sushil is asking, what do you mean by treasury management? Yeah, so treasury management is this only. So treasury management is actually this only, right? Where you try to manage your entire working capital as well as you also maintain the financial risks under control. So financial risks has interest rate management and forex management, right? So I would say that working capital management is part of the treasury management. So let's say it also means you are planning, organizing, and controlling the funds and working capital of an organization, right? So that you make sure that let's say this analysis that I was telling you, right? Payables has to be done in 30 days, receivable are coming in 60 days. So this is a mismatch. So this treasury department will think of that for next 30 days, can we arrange some funds, right? So all these activities will be done by the treasury team students. Okay. Now, so there are these different functions of the treasury team that they do. For example, they will do the cash management. Now we're talking about the functions. Okay, they will make sure that the cash collection process is efficient, right? We are not losing. For collecting the cash, we are not paying anything, right? So the cash holding cost is negligible. Then currency management, as we already discussed, right? Because the businesses today's needs different currencies, and hence we are exposed to the different kinds of forex risks. In your CA final, you will be studying about foreign exchange risk management, right? As a complete topic in financial management. Then fund management. Fund management again is the excessive or shortage of funds, right? Then banking. Banking, we mean they have to maintain a relationship with the banks, right? Because if you maintain a relationship with the banks, tomorrow if something needs to be done on an urgent basis, that treasury team will get it done. Let's say tomorrow they want some, some bridge financing or some financing at a lower rate, so that will be done from the banker's side. And finally, corporate finance. So corporate finance is basically acquisition and divestment activities within the group. For example, any sort of a investor relation, so they will manage it. So that is how the treasury department is structured in any of the organization, right? So why is that we are studying? Because treasury handles the major part of the working capital and they manage the working capital, students. Okay, clear, students? So now let us take a break of 10 minutes, students, right? And then we will again continue with the balance part. Thanks for your patience listening. We'll catch up again. Welcome back, students. Let's solve another categories of question. So see, one category of question is what we just now did that appeared in November 23 as well, which is the estimation of the working capital, right? That a new company want to do or any other organization would want to do for a better planning. Now, second set of questions is wherein they want to evaluate any credit policy or let's say the policy of how they have extended the credits to anyone. Okay, so I'm just taking this question from our study material itself. Okay, and this question number is the 12th question number from the practice questions. Just a second, I'm just flipping it on my screen. This is a very good question indeed, and hence this will help us in explaining some of the concepts. Let's jump to that question number 12. I think that is after MCQs. Yes, here it is. 8, 9, 12. Yes, perfect. Yes, so let us start, students. As a part of the strategy to increase sales and profits, the sales manager of a company proposes to sell goods to a group of new customers with 10% risk of non-payment. So if you see, they also know that, if you have to increase your sales and profit, you have to sell it on credit. Then only major, you will be able to attract more customers and hence you will be able to sell more, but it has a risk of 10% non-payment. This group would require 1.5 month credit and is likely to increase sales by 1 lakh per annum. Okay. So the sales will get increased by 1 lakh. However, they will need 1.5 months of credit. The production and selling expenses amounts to 80% of the sales and the income tax is 50%. So the cost of goods sold and even the cost to sell is around 80% of the sales. Income tax rate is 50%. The company's minimum required rate of return after tax is 25%. So they have mentioned to you that at least 25% they expect as their minimum rate. Okay. The should the sales manager proposal be accepted? Analyze. So they are saying that should you accept this proposal? Now, if you see this question, student, this is a very typical question, right? Now, all the data is given here on an incremental basis, right? They have not told you that entire pre-situation is this much, entire post situation is this much. So they have given only the that what is the incremental sales is going to be on that sales, how much margin are we going to earn, how much tax are we going to pay. So that is how the incremental things that they have told. Okay. Perfect. So let us go to the solution part and let us put these numbers here. So we are solving solution question number 12, practice questions from study material. Okay, now first of all we have to evaluate the proposal, right? So statement showing evaluation of proposal, right? The proposal is straightforward. First we have to see that what is the expected net profits, right? I mean, if the profit increases, then why not? We can accept the proposal. First of all, our net sales are increasing by 1 lakh. In this, we will reduce the production and selling expenses at the rate of 80% of 1 lakh, right? That is also mentioned in the question. So in a way, whatever incremental you will sell, you will keep on incurring this 80% as a variable cost. So this 20,000 is basically their regular profit. So profits before bad debts is this much. Now, if you have read, this proposal said that 10% there is a risk of non-payment. 10% it's going to be bad, right? Less bad debts at the rate of 10%. Around 10,000 will get reduced. So the profit before tax comes out to be 10,000. Correct? Now, in this, we have to reduce the tax at the rate of 50%, 5,000. Finally, it will show as 5,000 students. Yes, Devesh, your answer is correct. 80,000 is the value for COGS. So profits after taxes 5,000. Okay. Now, the opportunity cost for investments in receivables has to be seen here, right? So let's do working note 1. See, if you see on a standalone basis, 5,000 extra income is coming, that is okay. But this has to be compared with the 25% expectation that the company is holding, right? So what we will have to do is simply we will have to just take the, because this had we have not given this 1.5 months credit, we would have enjoyed the opportunity. I mean, we have enjoyed the interest income in the way of another opportunity, and hence the opportunity cost here is the interest lost. Opportunity cost is equal to total cost of credit sales multiplied by collection period divided by 12, right? Because this total cost is the this total return is the annual return, right? Annual amount that we will have to take it for 1.5 months, because on an average it will be outstanding for 1.5 months, right? Not for the entire period. So hence collection period divided by 12, and on that the return percentage. So if we solve this, the total cost of credit sales is around 80,000. Correct? Now, students, again, remember this is cost of the credit sales, not the sales value of the credit sales. Okay. PAT is 5,000. Sushil, your answer is correct. Okay. So what I was saying is that we have taken the cost of the credit sales, not the actual credit sales itself, right? For the obvious reason that we have to deal with the cost. So 80,000 multiplied by 1.5 divided by 12 into return percentage is 25%. 1.5 divided by 12 into 25%. 80,000 into 1.5 divided by 12 into 25%. This is 2,500. So for 1.5 months, if we are blocking our funds, right? So we will at least expect 2,500 to come as a return. Clear? I hope the comparison is clear, students. So this 5,000 what we are getting, again this 5,000 our opportunity cost of investments in receivable is 2,500, and hence the net benefit stays as 2,500. Okay, so the net benefit stays as 2,500, and hence this is what we should accept the offer, because after taking into account the opportunity cost of the investment in the receivable, still we are positive. So our advice is the sales manager's proposal should be accepted. Okay. Okay. Sweetie Kumari Singh, please explain the comparison again. Perfect. I will tell you. Are there any other questions? No. Okay. So hear me out. Students, I request everyone to please hear me out. See, there are two alternatives available with the company. What are they? Alternative one, give credit of 1.5 months and get 5,000 rupees. Okay, this is alternative one. Second, okay, I will say, let's say rather than give credit, I will say invest 80,000 for 1.5 months and get 5,000 from that sale event, right? Which is this net profit after tax part that we have taken here. Clear? However, so this is alternative one. Alternative two is just do a simple investment of 80,000 and get 2,500 at the rate of 25% return, right? So in alternative one, actually you are getting it through extra sales. I am just mentioning a invest just to give a clarity, right? Although it's not investment, you are giving credit, but I'm saying still it is an investment, right? Since you're giving credit for 1.5 months, 80,000, you are getting 5,000, and here 80,000, you're getting 2,500. So which one is better? Alternative one is better, because after you have got 5,000 from that, even you reduce the opportunity cost of 2,500, still you are positive. Clear, Sweetie Kumari? Okay, perfect. Let's go ahead. Now, so this was part one. Perfect. Now, what was the other part? What was the other part of the question? It has gone up again. No, wait. Perfect. Let's go to 12th question from down. Yes. Also compute the degree of risk of non-payment that the company should be willing to assume. Also compute the degree of risk of non-payment that the company should be willing to assume if the required rate of return were 30%, 40%, and 60%. Now they're saying that you increase the required rate of return from 25 to 30, from 25 to 40, and 25 to 60. Then the degree of risk of non-payment should be willing would be how much? Because as of now, the degree of risk of non-payment is 10,000, right? Which is 10%. So they're saying how much you can more shell out so that you are getting, and at the same time, this 25% is 30, 40, and 50. Okay. Now let us see that. Okay. We were here. So statement showing acceptable degree of risk of non-payment. Okay. Okay, sweetie saying crystal clear, sir. Okay, thank you. Thanks a lot, sweetie. So, statement showing acceptable degree of risk of non-payment. Now, please focus here. Okay, for 5 minutes, just listen to me. I understand it's a bit tricky one, but please be with me. Okay, what I am telling you, just keep it in mind. So, there are three required rate of returns that they have given us. Last one is 60%. Okay, now let's put all the numbers together. Sales. It will not change. It will remain same, right? In all the three cases, sales will remain 1 lakh less production and sales expenses 80,000. Okay, this was the production and sales. Then profit that we will get is 20,000, but this is before bad debts. Okay, so this is 20,000, 20,000, and again 20,000. Clear? Now, this is a tricky one where they are saying you need to tell us that how much bad debts we can make. How much bad debts we can make. So let's assume X, and X here, right? In all the three situations, I'm assuming let it be X. Finally, whatever amount comes, it has to be zero, right? I mean, from the PAT perspective, I'm saying. So profit before tax is how much now? 20,000 minus X. Here also 20,000 minus X and 20,000 minus X. All the places it will be this. Okay, so this is profit before tax. Now let's apply tax at the rate of 50%. So this will become 10,000 minus 0.5x minus 0.5x Okay, all the places this will be this. So this is PAT actually, not tax. This is PAT. Okay. Now, what is the required rate? Required rate here it is 30% of 1 lakh. Wait, it was how much? Okay, I thought it was data's batted. So required rate was in the formula we have to compute, right? So for the first one, 80,000 for 1.5 days for 12 months, right? Into 30% for the first case. So 80,000 into 1.5 divided by 12 into 30%. So around 3,000 is the opportunity cost, right? 3,000 becomes the opportunity cost. Then for the second case, it will be 80,000, 1.5 divided by 12 into 40%. So 4,000 will become the opportunity cost here, right? And then finally, 60% becomes the opportunity cost here. So this is around 6,000. So ultimately, if this amount equals to this amount, that is where the break even will come, right? And till that level, we can accept the risk of non-payments. So now the computation of the value and percentage of risk of non-payments, right? So let's take for case one, where we have 10,000 minus 0.5x is equal to 3,000. No, Devesh is asking 0.5x. Why? Because tax is there, right? So if let's say PBT is 20,000 minus x, after reduce 50%, it will become 10,000 minus 0.5x, right? You will multiply 50% everywhere. Okay, that's why Devesh we have taken that. Okay. Now, if we solve for this, then this will become 7,000 divided by 0.5 is equal to x. 0.5 is equal to x. So x is actually 14,000. And in terms of percentage, this will become 14%, right? Percentage of sales, 14,000 divided by 1 lakh. This is for case one. Now, case two, this is important and this is important. Case two is actually 10,000 minus 0.5x is equal to 4,000. 0.5x is equal to 6,000 and x will be 6,000 divided by 0.5, which will be, I think, 12,000. Yes. Percentage of sales, this becomes divided by 1 lakhs. 12%. The moment you see that the opportunity cost is increasing, the percentage is also decreasing, right? The moment I say that I have higher opportunity cost, the maximum level of acceptability that will be there with me will become lower, right? So case 3. Very good, Devesh. Your answers are correct. Very good, Bhumika. Your answers are also perfectly correct. Case 3, we have 10,000. 0.5x is equal to 6,000. So this will become is equal to 4,000 and hence x will be 8,000. Percentage of sales, this will be 8,000 divided by 1 lakh is equal to 8%. Okay. So just to say that the acceptable degree of risk of non-payment is 14%, 12%, and 8%. If required rate of return after tax is 30%, 40%, and 60% respectively. I will show this for a couple of minutes before we go ahead and yes, Devesh, your answers are correct. Yes, Shambhavi, you are right. Bhumika, you are right. Ruhani, you are right. Perfect. So technically now I would suggest that please open the session for the students to ask live verbal questions, right? So they can unmute and ask. Students, in case you have joined through Zoom link, you are welcome to ask any questions related to the current topic, right? You can unmute yourself and speak since we are towards the last half an hour part of our session. You can raise your hand and then speak. I would be happy to interact with you. Let's take a 30 seconds pause so that all of you are catching up to the speed. Then we will do the next question. I hope the things are clear till now, whatever we have studied. In our next session, students, we will cover and deep question that has been selected in the AP for this time for May 2024, right? So that question we will be starting our class with, which is scheduled on, I think, Sunday, right? So today we will do one more question just to see the different levels or the different categories of question. Yeah, students. So let's go ahead. Let's take now question number 13. So this was question number 12 from the practice questions, right? Yes, question number 12. Let's go to question number 13 now. I'm again referring to the just a second. Yes. Slow payers are regular customers of good dealers. So slow payers are customers and good dealers are vendors and have approached the sellers for extension of credit facility for enabling them to purchase goods. So slow payers are asking good dealers to increase their credit period. On an analysis of past performance and on the basis of information supplied, the following pattern of payment schedule emerges in regard to the slow payers. So what they have done, they have seen their past payment performances. Basis that they come to know that 15% of the bills gets cleared in 30 days. 34% of the bills gets cleared in 60 days. 90%, sorry, 30% of the bills gets cleared in 90 days. Okay, let me just see if there are any other queries. No. Then 20% of the bills at the end of the 100 days, and 1% of the bill there is no recovery. So there is a possibility of bad debt equivalent to 1%. Slow payers want to enter into a firm commitment for purchase of goods of 15 lakhs in 21-22, deliveries to be made in equal quantities on the first day of each quarter in the calendar year. See, practically how it happens. I mean, if I go to a if I go to a vendor and ask for a credit, the vendor will quickly ask me that how much stable volume can I expect from you? If you say that you want a big amount of credit also, and still you are not giving me a minimum assurance on the purchases that you will do from me, I am not having any assurance, right? That's how practically it happens. So, so a person who is selling the goods will try to negotiate better, right, in terms of the minimum volume that he or she can expect, provided they will be able to give the credit. So they have mentioned that 15 lakhs is what they have entered into the firm commitment. The price per unit of commodity is 150, on which a profit of rupees 5 per unit is expected to be made. So 150 rupees is the price, and on that 5 rupees profit is expected to be made. It is anticipated by Good Dealers Limited that taking up of this contract would mean an extra recurring expenditure of rupees 5,000 per annum. So they are saying that if goods dealers are taking up this contract, they will have to incur extra expenditure of 5,000 if the opportunity cost of funds in the hands of good dealers is 24% per annum. Would you, as finance manager of the seller, recommend the grant of credit to slow payers? Analyze. Working should form part of your answers. Assume year of 365 days. Simple, right? So the situation is very simple. They are saying that um, for purchasing the goods, slow payers needs extension of the credit period. Now, the moment they do that, there are some cost implications to the good dealers. Sorry. Now we have to compare those cost considerations along with the possibility of the extension of credit. Okay. Any questions, students, that you want to ask, please do let me know. You can ask verbally as well in the class. Perfect. So now we are heading to question number 13. Okay. So statement showing evaluation of debtors policies, right? Because we are evaluating it from the perspective of the seller, right? So as we discussed, first of all, we need to understand that what is our profit. First, there will be credit sales of 15 lakhs. Okay, 15 lakhs is the credit sales. Then the total costs that we are incurring will be variable costs, right? Why, from where we have got this variable cost, students? Come on, tell me. If I talk about, there are two costs. Okay, this much hint I can give you. There is a variable cost and there is a extra cost, right, of accepting this order. So I can say recurring cost. That is straight away given as 5,000. Now, what about this variable cost, students? Yes, you're right, Devesh, that we would have also followed that route of 1,000, 10,000 units into that. But why we are not following will be clear from this step actually. There is a reason to it. Now tell me, students, from where I can get this variable cost? Just read the question and tell me. Is there some hint that is given in the question? Anyone can wants to try this? I'm just seeing who all are there. No worries. Okay, let me tell you. It is mentioned that 150 is the selling price and 5 rupees is the profit. So that means 150 minus 5, right? Into number of units. So this will become 150 minus 5, right? And 150 was the price for 15 lakhs, right? So in totality, it is 10,000 units. So 14 lakh 50,000 becomes the amount. Yes, Kiran, your answer is correct. You have responded. Sweetie, 150 is the selling price. Perfect. But we are talking about the variable cost. Okay. So bad debts. Now, okay, first of all, we have to see that how much is our overall cost coming out to be 14 lakh 55,000, right? So this becomes our total cost. Now, 1% was the bad debts, right? 15 lakhs at the rate of 1% is 15,000. Let me not put the brackets. This is bad debts. Then the expected profit will be how much? 15 lakhs minus 14 lakh 55,000 minus 15,000, around 30,000, right? So the expected net profits will become 15 lakh minus 14 lakh 55,000 minus 15,000, which is 30,000 students. Okay. Now we have to see and compare this with the opportunity cost of the investments in receivables, right? How we have to calculate that? Working note. Calculation of opportunity cost of average investments. Again, we will use the same formula here, students. How we can calculate the average cost? So we will calculate opportunity cost is equal to the total cost of sales, right? Multiplied with the collection period, multiply with the rate of return, right? This was the formula. Okay. Now, as per the split that is given to us, there are different bill amounts that are settled in different ways. Yes, Devesh, your answer is correct. So we can mention 15%, 34%, 30%, and 20%, and finally total. Okay. So the total cost for the 100% value is 14 lakh 55,000, right? Okay, that is okay. Now, out of this total cost, cost pertaining to respective sale is how much? Now for this, we have to do 1455 multiplied with 15%. Here 1455 multiplied with 34%. 1455 multiplied by 30%. 1455 multiplied by 20%. And then we will take a total here, right? So how much this will come out to be? 1455 into 15%. 218, 250, 1455 into 34%, 494, 700, 436, 500, and then 1455 into 20% is 2,91,000, and the total here will be 99%, right? Because 1% has gone bad. 15 plus 34 plus 20 plus 30. 99% of 1455. 100. 14,40,450. Yes, Devesh, your answers are correct. You're right. Now, let's take into account the collection period, students. Now, for 15%, the collection period was 30 days. Right? For 34%, the collection period was 60 days. For 30%, the collection period was 90 days. And for 20%, the collection period was 100 days. Okay, clear? The required of return is 10%. Okay, and hence the opportunity cost will be let me put here 218, 250 into 24% into 30 by 365. Right, similarly for second case, I'm putting it here 494, 700 into 24% into 60 days divided by 365. For third case, I'm writing here. Third case is 436, 500 into 24% into 90 days divided by 365. And for the last one, it is 291 into 24% into 100 divided by 365. This is the last case. Okay. So the opportunity cost here, it becomes 218, 250 into 0.24 into 30 divided by 365, 4305. Next one, it becomes 494, 700 into 24% into 60 divided by 365, 19,517. 436, 500 into 24% into 90 divided by 365, 25,831. Right, because the period is also increasing, right, from 30 days to 90 days, hence there is an increase there. Then finally we are at the last case, wherein 291 into 24% into 100 divided by 365. So 19134. So 19134 plus 25,831 plus 19,517 plus 4305. So the horizontal summation here is equal to 68,787. 68,787. So this is the overall cost of opportunity cost that the company will lose in case they decide to go for this sale. Bhumika, your answer is correct. 1440,050. That's for the total that you would have mentioned. Devesh, your answers are perfectly fine. Very good. All those who are solving and all those who are listening. Now, this we will compare with the less opportunity cost for giving credit. 67, 68, 787. How much it becomes finally? And there is a question from Sweetie. I will just respond to that. 68, 787 minus 30,000. It becomes negative 38, 787. So this is net benefits, which is actually a loss here, right? So our recommendation is the proposed policy should not be adopted since the net benefits under this policy are negative. Okay, so it's just a simple comparison where we compared the expected profits along with the opportunity costs, and we came to know that it's negative and hence we are not going to accept this policy. Now let me see. Yes, Devesh, you are right. Now Sweetie is asking, sir, what about the extra cost of 15,000? I think extra cost is 5,000 here, right? Bad debts is 15,000 and extra cost that is mentioned in the question is 15,000. Sorry, 5,000. This one. This we have already adjusted, Sweetie. This we have already adjusted. Okay, now any questions, students, that you want to ask verbally, because we are left with another 5 minutes in case you have anything, or until then we will just revise today's concepts. We'll just wrap it up so that in the next session we will do the deeper questions now, taking it ahead. So students, we started our discussion with the basics of working capital. First of all, we discussed what is a working capital really is. We said that there are two kinds of capital in any of the company. One is the working capital for day-to-day affairs of the company, and second one is the long-term purpose, investment that we do, for example, in property, plant and equipment, fixed assets, and everywhere, right? Now this working capital, if we take it ahead, it takes the form of current assets and current liabilities. The difference between both of them is taken as working capital. Now current assets and current liabilities have their own definitions, which are actually borrowed from the reporting concepts, which says that anything which is expected to be settled within the operating cycle of the company or 12 months, whichever is longer, has to be classified as current. And apart from that, any inventories are also classified as current. Similarly, for liabilities, so we have used that classification. Now, the next bigger part was on the determinants of the working capital. How should we determine the working capital? In that, the biggest thing was to evaluate, or to, let's say, come up to the levels of the individual amounts of the working capital students. Okay. For doing that, we have certain formulas. So if we have number of days with us, we can calculate the levels of the working capital. And there were certain yardsticks, there were certain details that we discussed what all factors will impact the working capital amounts, right? Then we also discussed about the working capital cycle. How does the working capital cycle looks like? It's simply debtors, inventories, and other things minus the payables amounts that we do as the operating cycle for the company, right? Then we also understood a very important adjustment, which is on account of the cash cost of debtors as well as inventories. Because the moment if we say that the debtors includes profits, so it also includes the depreciation, so which essentially means that it will have an impact on a higher, or let's say inflated amount that being shown to the working capital analysis. So as a preference or as a thumb rule, we always reduce the depreciation and profit margin while we calculate for the debtors amount. However, it is equally okay if you include that. Okay, there are alternative solutions for that. From the finished goods, we have to be careful while we eliminate the depreciation amount, because finished goods valuation often includes that. Then we did certain questions on how do we estimate the working capital, what are the functions of the treasury team in any of the organization. Those are very, very important. Management of working capital being very important function for them. And lastly, we discussed about how to evaluate whether giving a credit is making more sense or not, given the fact that we are incurring extra expenses, given the fact that there will be risk of non-payments, right? And given the fact that had we not given this in the debtors ways, we could have invested and earned some sort of a extra income, students, right? So we have to compare that with the, I mean, that as an opportunity cost for giving the credit to the different customers, right? So that's all from my end for today, students. I request all of you to please go through, discuss, and revise. And in case you have any queries, please do let us know in the next session. So till then, please have a patience. Thank you for the patience listening, and please do revise well. Thanks a lot, Ruhani. Thank you, everyone. Devesh, Sumit.
Thank you, everyone.
Thank
Thank you,
you.
sir.
Thank you, Devesh. Thank you. So technical team session is over.
Thank you, sir. Thank you, sir.
Thank you, Kiran. Thank you. Okay.